I hope you all have registered with the stock track platform. How is your trading going? Positive. Anyone who has not yet registered? Well, today is the deadline. I know there are issues with the stock track platform. They have this, they have a bug in the system. Certain machines, Macintosh, as well as certain browsers create some errors. So all you can do is you can try with another machine, PC, and also browsers like Chrome or Mozilla should fix it. If you don't have it, or if you can't have access to those things, which is very unlikely, send your details to StockTrack and they will register for you. Then you will have your account and start trading it. So I have provided these details on Cloud Deacon. So please follow that and do it accordingly. Otherwise, what will happen is you will run out of time. You will not have enough time to do a proper assignment, right? Do a proper job. You need to adequately trade and observe, learn from your mistakes, and then from today's topic, you will learn as to how you go about selecting stocks in a systematic manner, particularly the top-down approach, where you look at the large economies, regionally, globally. Then you get down to the industry level analysis and pick those winning industries, those that are, those that are regarded as the best performers, and then move to company level analysis, right? Now, as I said, we have a simple contractual arrangement here. You need to pass, I need to make sure that you adequately learn. Going beyond that, you need to spend your time. You need to spend your time and create a passion to learn about what these major things that matter in terms of setting the trend for capturing the trends of a given market, or how you can predict how the market is going to go. These are very practical things. When it comes to sitting with people and talking about how the equity market is going to go, or how the fixed income market is going to go, you need to have some insights as to what those indicators or what those series that can give you some indication on how the equity market is going to go over the next 4 or 5 quarters, or into the foreseeable future. To do that, you need to do a lot of reading. And also, you have enough resources. The library has databases on industry analysis. When you study, you should make use of them. Go to the librarian and ask the librarian for help. They will assign a particular person to help you. Just if we do a lip service, just let's look at it and read it, complete this course, it's not going to be rewarding. You need to be, and nobody can teach you. Honestly, if anybody can teach you. You are the only person who can teach yourself. I'm just here as a coach, just guiding, and so I cannot teach. You have to learn on your own and make it as a habit to read Financial Review, the Australian Financial Review, the Financial Times, the Wall Street Journal. All of these resources are available on the library webpage. They spend a lot of money to keep those available for you. So make it as a habit. And that is the only way we can learn. We need to have interest, and we need to create that interest. And if there is an issue, you need to tell yourself, I'm going to resolve this, rather than approaching anybody else. Make it as a habit. I'm going to dig deeper and see what's in there. So that's how the learning process can take place. Sitting and just doing lip service is not going to work. It may work for passing the exam, so what? It's just passing the exam. Beyond that, you need to have that drive to learn and do things. Everybody, if you do a reasonable job, you will pass. But what you need to do is you need to create that need. You need to create that passion to go beyond your boundaries and read those things and understand. Okay? So, having said that, this is the mic is missing. Last week I could not complete those questions, so I'm going to touch on those questions and then get on with topic 2 on stock selection. Right. So let me just pull this question from the... By the way, I have also uploaded your, under the Learning Resources folder, under the Assessment Resources, you will see the rubrics. Okay? So it is a guide. It is a guide that tells you what needs to be done to get your 10 marks. So you can use this as a guide to write your reflection report. Okay? And before you do that, a lot of things you need to do. You need to search for these resources, approach the librarian and search for industry related things, so that you will get some insights into what you are doing. Now, at the moment you are doing randomly. You don't even know what the companies are. You may just go and pick Telstra, Commonwealth Bank, BHP. These are known names. But do a bit more work, go beyond your comfort zone and do a bit more work and look at the Australian economy and how it's doing. If somebody starts a discussion, you need to have an intelligent discussion. How is the economy going? Why do we need to lower interest rates? What is the yield curve telling us? These are some of the things that if somebody asks you, what are those indicators that we can rely on to see what's going to happen to the economy? Or what's going to happen to why does the stock market matter? There are answers, okay? There are answers in the textbook. And also, have you got your textbook? Yeah? Spend this, 75 or 80 bucks. It's just peanut. when it comes to spending the money and gaining the insights. Without, one may think that I can do. I provide those questions. Yes, that's true. You may think I can do by just looking at those questions and doing the things. Yeah, you will do a minimal job, but there are quite a good things in this textbook. Spend your money and read it. It may be just there is an online the soft copy. They have a coupon as well, so buy that, please. It's just if you don't have it, then it will be it will not be a proper job. So you need that resource. That is important. Okay, let's go to that's your rubric. Have a look at it and digest it and see what you need to do. Okay, let me just go to financial markets. Okay, so last week we could not do this. Let's start with problem number 5. Problem number 5, that is from which chapter? It's chapter 1. Problem number 5. During the past 5 years, so they are talking about the past history. Now, in the last class, we looked at markets, required rate of returns, how you form required rate of return. There is a sacrificial thing that you do. For that, you expect some time value of money. And then there is inflation, that is the reality. So we need to pay for that premium. And also there is uncertainty. So these 3 components are built into the required rate of return. Then we looked at some of the risk return measures, looking at the historical data as well as the expectations based data. Bless you. Now, if you look at problem 5, this is about the past history. Past history. From year 1 to year 5, they have given the return for 2 stocks, stock T and stock B. Can you read at the back? Can? Anyone who can't? Yeah. Okay, so there are 2 stocks. Stock T and stock B. Compute the arithmetic mean annual rate of return for each stock. Which stock is most desirable? So we know that one of the measures that we use to make judgment on an asset is the return. And the other measure is the risk that we generate. Okay, so let's compute the arithmetic return. That is simply, let me just use this document camera. Is it readable? My handwriting is terrible. I hope you can make sense of it. Okay. So that is stock T. So over the last 5 years, it has generated 19%, 8%, and negative 12%, negative 3%, and 15%. So arithmetic return is just summing up and dividing it by the number of years. We have 5 years, so you sum it up. That comes to 0.27 for stock T, It is sigma I1 to I5. I is equal to 1, I'm talking about 19%. When I is equal to 2, I'm putting this through the loop, I'm talking about the second return. When I is equal to 3, I'm talking about the third year return. And I is equal to 4, I'm talking about the fourth year return. When I is equal to 5, I'm talking about the final year return, that is 15%. So we add them up, that comes to 0.27, and that is over the last 5 years. So for a given year, it is 5.4%, 0.054. The same way, for asset B, stock B, we have individual return 8%, 3%, negative 9%, 2% and 4%. So you sum it up, that comes to 0.08. Divide that by the number of years, 5 years, that gives you 0.016. So effectively, by investing in asset T, historically, it says you will be able to earn 5.4% if everything goes accordingly. And by investing in asset B, you are going to earn only 1.6% on average. You know, there is variability. So which one would you prefer? Obviously, the higher the return, because we want more to less, right? So we like the better return, 5.4%. So we prefer stock T to stock B. But that is only a partial story. There is the other side of the story, is the risk aspect. Part B is about compute the standard deviation of the annual rate of return for each stock. We computed the average return over the last 5 years, and we decided we would go with asset T, right? Because we had 5.4%, whereas asset B only earned 1.6%, which is not very attractive. But let's look at the, well, that is only a partial story. Now the other side of the story is risk. We measure risk using standard deviation, right? So for each stock you need to generate the standard deviation. I know you have the answers, but I just thought I should write this and show you. So before you arrive at the standard deviation, you need to generate the variance, right? It is the square root of the variance which gives you standard deviation. Why can't we work with variance? Well, variance doesn't tell us anything. It is a figure, it is not in the normal form, it is in squared form. So we need to normalize it by taking the square root of the variance to compare it with the return. When you take the square root of the variance, you normalize it and you are able to compare apple with apple, return with return, right? Okay, so we know that from year 1 to 5, we have 19%, 8%, 12%, negative 12 and so on. So what we need to do is we need to first generate this excuse me, we need to generate this deviation. So what we want to see is, in order to assess this risk or standard deviation, we want to see how each return deviates from the average return. We know the average return for stock B is 5.4%. We want to see how individually each return deviates from the average return. So 19% minus 0.054, then we need to square that, right? Because then we'll have negative figures sometimes, sometimes positives. We want to eliminate those things. So we want to square them. 0.19 minus 5.4%. 5.4% was the average return that we generated previously. So that gives us 0.01850. When you do that in the exam, make sure that you maintain all the digits. Do not round it up in the middle of the calculation because it will introduce a lot of errors. So make sure that you maintain all the digits. And the second return is 8% in year 2. That deviates from the average return by 0.00068. And I think that is the squared value. So the third year return is negative 12% minus 0.54. Squared value is 0.03028, and we sum it up as 0.06574. So what we do is we take individual return. We already generated the average return as 5.4%. We work out the deviation, we square them, and then we sum it up. That's sum is equal to 0.0654 6574. If I go back to the the variance equation here, where is that? Right. If you look at here, can you see this? Is it clear at the back? Yeah, you can read that, right? Okay. So if you look at this one, this is only with the probability. All right, we can look at this. See, what happens is, here we have the historical holding period yield, HPYI, minus the expected holding period yield. If you go back to whole thing squared, you sum it up and divide it by n. This is your variance equation that we are dealing with here. So if I can move this, the 5.4% is the historical expected yield, and this is the holding period yield for year 1, year 2, year 3. We take the holding period yield and take away that average yield and square it up, and that we extend here, and sum of that is 0.6574. So variance is equal to 0.6574 divided by the number of years. We can go for n minus 1 or n. Let's keep it as n for the time being. That gives us 0.01315. What is that 0.01315? Does it tell us anything? That is the variance figure. Does it tell us anything meaningful? Well, it doesn't tell us anything meaningfully, right? We cannot interpret this. So what we need to do is, because we squared them, we need to take the square root of that value to normalize it. Now it tells us the square root of that 0.01315 is equal to 0.11467. Now it tells us the The risk associated with that is 11.46. We can comfortably say 11.46 or 47%. Right? So on average, stock T earned a yield of 5.4%, but the underlying risk associated with that stock is that 11.4%. So what does this 11.4% mean? So 5.4% means what? That 5.4% means what? On average, if you invest in that company, you're bound to receive about 5.4%, right? That's an average return. But things can go wrong as there is variability in return. We know that in year one we earned 19%. On the other hand, in year two it came down to 8%. Think about year three, we ended up with negative 12%. So that introduces this variation, right? The variability in return. That has been captured in this 11.47%. That tells us how risky this company is. Go back to your topic 1 lecture. One of the three components that contribute to the return that you demand from an investment is that the uncertainty associated with that cash flow. So you will factor in that uncertainty when it comes to investing in that asset. That uncertainty is captured by this element, right? Okay? So we will do the same thing for stock B as well. We know stock B had a return of, average return of 1.6% from the previous calculation. Average yield of 1.6%. So what we do is we generate the deviation for each year, 8% minus 0.016, then square it. That is equal to 0.00410, and you do the same thing for year 2, and year 3 of course you have a negative value of 0.09 minus that average yield of 1.6%, 0.016, that gives you this value, and sum it up. Sum is that squared sum of value is 0.01614, and that of course is the sum of the squared values, and that needs to be brought to an annual value, so divided by 5 years. 5 gives you 0.00323. It doesn't tell us anything. That is the variance value. Then we take the square root of that variance. That tells us 0.05681. So, initially, we decided to go with stock T. Because stock T had a return of 5.6% compared to stock B, which earned a return of 1.6%. Now we know the story is different. Even though stock T earned 5.6%, but the underlying risk associated with that stock is 11.47% or whatever. Whereas stock B earned a return of 1.6%, but the risk associated with that investment is 5.6%. Purely looking at the risk side, we are averse to risk. We hate risk. We do not like to take risk as investors. So we would like to go with stock B. The story is different, right? So stock B is prefer to stock T as it has lower risk because we don't like risk. Okay, but that's not the complete story. That's not the complete story. Yes, stock T has lower risk, stock B has lower risk, but stock T has higher return. Purely looking at individual measures, we can say based on return, we would go with T. Based on risk, we would go with B. But then we need to bring them to a common ground to assess per unit of risk, how much return are we generating? That is the question that we need to ask. So compute the standard deviation of annual return for each stock that we did. And by this measure, we prefer stock B, right? Agreed? Yeah. And but then that's not the complete story. We don't know really which one is better. To do that, when you have the same return but the risk is different, you can go with the lower risk. Or if you have the same level of risk for both assets, but the return is different, then you can go with the asset that produces higher return. But here we know that the returns are different, but the underlying risk associated with them are different as well. So in order to make a judgment on this, we need to bring them to a common ground. That common ground is the coefficient of variation, right? CB. So the coefficient of variation is simply dividing the standard deviation by the expected return. So for asset T, the standard deviation was 11.466%. And to bear that risk, it generated 5.4% return. For asset B, the standard deviation was 5.6%, 5.682. To bear that risk, we earned a return of 1.6%. So what we want to see is per unit of return, how much risk are we going to take with respect to each investment? The coefficient of variation is going to tell us per unit of return, how much risk are we going to bear. So in this case, in order to earn 1% of return, we bear 2.1% risk.
Just push your book up a little bit.
Oh, sorry. Thanks, Peter. Oh, my goodness. I should have done that. Thank you. Okay. I should look back all the time. Yeah, thank you. Thanks, Peter. So this coefficient of variation is basically you divide the standard deviation of 11.47% by the return that you earn. So what does it produce? That figure of 2.123, what does it mean? In order to earn 1% of return, we need to bear 2.123% of risk, right? For asset T. Whereas for asset B, to earn 1% of return, you need to tolerate 3.5% of risk. 3.55% or whatever, 3.5513% risk. So per unit of return, you are better off here. Why? Because as investors, we hate risk, we don't like to take risk, so we just would be happy to have lesser risk compared to having greater risk, right? So we like to invest in, we would go with investment T, right? Stock T is preferable. Does it make sense? Yeah? So initially we looked at return, we decided to go with T, but then we generated the risk measure, we decided to go with asset B, but those two decisions were premature decisions. Then we brought them to a common ground and understood that asset T stands. Asset T generates a return with lower level of risk, right? So that makes sense. Does it make sense? Any question? Yeah.
I'm just trying, how would I apply that in a scenario where if the bond, I've got total confidence in getting a return on the money at 2%.
Right.
And then they tell us that you need to factor in risk when risk's there, so I should expect an additional return of 2.123% on my investment.
Okay, so that's a good question. How would we apply this? We would apply this when we compare two investments. If you have two bonds that produce different returns and their underlying risk also, you have different risk level as well. So in that situation, what you want to see is per unit of return, how much risk are we bearing? That is the question that we need to ask. So with asset B, we bear higher level of risk, 3.5% risk. In order to earn 1% return, we need to bear 3.5% risk in asset with respect to asset B. Whereas with respect to asset T, to earn 1% return, we are going to take only 2.12% risk. Okay, so does that make sense? So if you compare two assets which have different returns and different risk levels, then you need to bring them to a common ground by generating the coefficient of variation and make a decision. Thank you. Any other question? Yep.
Always the risk would be high and the return would be always be high according to the capital model.
That's true. Higher the risk means higher the return.
So we will always have the same answer for the stock or the asset which is having the higher risk.
But here we need to see relatively which one is bearing higher risk.
So by looking at two assets, if the asset A is having higher risk, so it will say that it directly proportional, it will say that it will have higher returns.
It will have higher returns.
So by looking at it, we can say the stock A is better than stock B. But if the risk is very high,
the issue here is, I agree that higher the return means higher the risk. But why do you want to take unnecessary risk? Simply, if you look at this, these two assets, to earn 1% return, you have to bear 3.5% risk. Do you get enough return there? No, you don't. You are bearing unnecessarily increased level of risk, right? It doesn't warrant that risk level, right? Okay. So going back to this, going back to the simple scenario of asset, let's say asset T. Asset T had a return of what? 5.4%, right? 5.4%. And the standard deviation was 11.46, right? Return SD, 11.46%. Let's put this in context. What does this mean? If everything goes well, provided there is one standard deviation, we are 67% confident, your return is likely to be, in the best case scenario, 5.4% plus 11.46%, that is equal to what? 16.86%, right? But in the worst case scenario, this 5.4% can be negative 11.46%. That means you may end up with 6.06%, negative 6.06% return, right? 6.06, right? Right. So what it means is that if everything goes well, by investing in asset T, you may end up with 16.86%, or if things go badly, then you may end up with negative 6.06%. This is only considering one standard deviation. Then you can go for 2 standard deviation and 3 standard deviation to do the sensitivity analysis. So this tells you the level of risk you undertake and the return, possible returns. So if everything goes well, you may end up with 16.86%. But if things go wrong, you may end up with negative 6.06%. So that is the range. Does it make sense? Yep. So we take return, we take risk, and see the range and make a judgment. You can also go for the 2 standard deviation and tell the investor, okay, this is the other range that you may end up with in a very bad financial crisis or something, right? Okay, so that's all about that. Compute the coefficient of variation. Use chapter 1. Right, by this relative measure of risk, which stock is preferable. We generated the coefficient of variation. We saw that stock T was the better performing stock, right? And you can see that range. Then question problem 5D. D says, compute the geometric mean of return for each stock. Discuss the difference between the arithmetic mean and geometric mean. As you know, we have already calculated the geometric mean, arithmetic mean, but we have not calculated the geometric mean. What we need to do is we need to calculate the geometric mean. As you know, this geometric mean is what? Is all the product of holding period yields holding period yields, and then we take the nth root of it, right? But this 19%, 8%, 12%, and 3%, 15%, these are not, these are just yields, right? So we need to make it as the annualized annual yield, so that holding period HPR, so that gives you 1.19, 1.19, 1.08 and so on. So the geometric mean is, we generate it by taking all the holding period yield. Is that the holding period yield, or we call it as holding period return? Sorry, it should be holding period return. So this is the yield, this is the return. So we take the holding period return, and then we take the fifth root of it. That gives you 1.19, and multiplied by that all the values. That gives you 1.047 minus 1, 4.757. So we generated a geometric return of 4.75%, but our arithmetic return was, for this stock, 5.4%, right? Arithmetic return was 5.4%. The geometric return is 4.7%. We do the same thing for asset B as well. So we generate the holding period return by just adding 1, so 1.08 times 1.03, all the things. Then we take the fifth root of it. That gives us 1.01435 minus 1 gives you 0.0135. So you know how to take the fifth root of it. Okay, so that is 1.01435 to the, sorry, 1.01435 to the power of 1 over 5. That gives us 1. Oh, sorry, that was the wrong figure, right? 1.01435. Yes. What did I do? 1.07383 to the power of 1 over 5. That gives you 1.01435 minus 1 gives you 0.014348, whatever, right? So you can see this is generating a return of 1.43%. This is 4.7%. Okay, geometric return. As you know, we looked at it. This is the arithmetic return, that is 5.4%. Oh, I'm just still making that 5.4%, and the geometric mean is 4.7 whatever that percent. For asset B, the arithmetic return was 1.6%. the geometric return was 1.4%. You can see the spread between these two. Can you observe the spread? The spread between the arithmetic return and the geometric return for asset T compared to asset B. Asset T has a higher spread, right? Asset T has a higher spread. Why? Because asset T had higher variability. Higher variability. When you have higher variability, what happens is the geometric return captures that and tells you the clear story, right? Whereas asset B did not have such variability. We also knew that it had lower standard deviation, so the spread is also lower, right? So higher the spread means there is higher variability associated with that stock. So geometric mean is more efficient in capturing the volatility associated with the asset, whereas arithmetic mean does not do that. We saw that in the last class through examples. So in terms of efficiency, geometric mean is more efficient in terms of capturing this variability. Okay? Any question on that? Makes sense? Okay. So that is last week class. I can turn this, right? Right. Now problem 6, I'll quickly finish that as well. I have already lost 1 hour. So let me just quickly go to problem 6. Okay. P6. You are considering acquiring shares of common stocks in Madison Beer Corporation. Your rate of return expectations are as follows. Now let me go back to, okay, so you can read that, right? Okay. So what does it mean? The possible rate of return of 10%, negative 10%, there is a probability of 30% chance. And possibility of earning zero return, there is a probability of 10% chance. Earning 10% return, there is a 30% probability. Earning 25% return, there is a probability of 30%. How did we come up with this probability? How did they come up with this probability? And how did they come up with this return? It's a scenario analysis. Let's say if the economy is going to grow at such and such percentage, this company will earn a return of negative 10%, right? And if the economy is going to perform in line with an average growth rate, this company is not going to earn any return. But if the economy is going to perform at an above average growth rate, this company is going to earn 10% return. So based on your economic analysis, industry analysis, then you come up with these probability values, right? Probability values and form expectations. So this is the expectation about this beer company under these 4 scenarios. We don't know what those scenarios are, but there are 4 probabilities, values they have given us. There's a 30% probability of this company earning a negative return of 10%. There's a 10% probability of earning zero return, and there is a 30% probability of earning 10% return, and there's another 30% probability of earning 25% return. The 25% return may be the economy is going to experience a supernormal growth rate. Who knows? We don't know. The underlying state we don't know, but there's a associated probability there. So all we need to do is we need to form the expected performance. So given the probability and the associated return, you can form the expected return by taking the individual return and attaching the probability associated with those individual returns. So the chances of earning 10% is 30% probability. So negative 10% times 0.3, that gives you 0.03. 0% return, the chance of earning 0% return is 10%, so that gives you 0. And then earning 10% return is 0.30%, so that gives you 0.03, right? And then earning a 25% return is 0.3 as well, that gives you 0.075. The expected value, sum it up, it is 0.075 or 7.5% return. So the expected return is equal to sum of all the probabilities of Ri, when I is equal to 1 to n. All the state of affairs, all the states are captured, right? So that gives you, you attach the probability and sum it up, that gives you 7.5%. So what does it mean? What does that 7.5% mean? The expected outcome, given the probability and the underlying return associated with each probability, we expect this company to earn 7.5% on average. It's similar to average arithmetic mean or geometric mean or that average return, right? Here only thing, the difference is, here we form expectations. Expectations we form using some states of the economy, states of the industry. Here they haven't given anything explicitly as to how they, what they mean by that 30%. In most of the cases they may say there is a 30% chance of the economy producing 3% return. There's a 10% chance of the economy going into recession, and there's a 30% chance of performing above average growth rate, and there's another 30% chance of producing a supernormal growth rate. So generate the expected return, then you generate these expected outcomes. So that is the expected return, right? So that's clear. Any question on that? We'll do more questions anyway down the track. It will be more meaningful to you when we go further down. And also then we will move to, there was a suggestion by one of the students to do problem 7. The stock of Madison Travel Company is selling at 28 a share. You put in a limit buy order of 24 for 1 month. So the limit order is placed. It's currently trading at 28. You have put in a limit order of, I can take this camera. Okay, you have put a limit order of $24. Can you read it, or do you want me to blow it up a bit? It's fine? Yeah. I haven't downloaded this. Okay, so it's trading at 28. You have put a limit order of at 24 for 1 month. During the month, the stock price declines to 20, then it jumps to 36. the question is, ignoring all the commissions and all, what would have been your rate of return on this investment? So you have put a limit order of 24. The stock declined to 20. At any time there would be a number of buy orders and sell orders, and as it hits that 24 criteria, that would have been executed at that price, right? So that limit order would have been executed as the price reached 24. Price would have further declined to 20, doesn't matter, because it was a limit order, it would have been executed at that price. At any time there may be buyers and sellers having all different buy and sell orders. And at the same time there are market makers as well. If there aren't enough sellers, then there will be market makers filling those positions as well. So that would have been executed at 24. So then the stock went to 36. So the return, I didn't write anything, so the return is 36 minus 24, given 24, it is 50% return. Then it's a bit awkward. Okay. What would be your rate of return if you had put in a market order? So is that limit order thing clear? It would have been executed at 24, even though the market declined to 20, because as it reached that point, it would have been executed, and the return is 50%, 36 minus 24. The second question is, what would be your rate of return if you had put in a market order? Excuse me. What would be your rate of return if you had put in a market order? Market order mean?
Current market price.
Yeah, current market price. So, 28 minus 36. 36 minus 28, you would have earned 28.57%. What would have happened if you had put a limit order of 18? The limit order of 18, that's what's the third question, wouldn't have been executed because the market didn't reach that level of it, only declined to 18. So the order would not have been executed. Okay, so that's all. Any question on that? Right. So I guess you would have done all other questions. Please make sure that it is your duty to do all those questions. We have limited time, limited resources to discuss. So I just select some of the important things and do it on my own and bring it and cover it in the class so that it takes minimal amount of time in terms of writing, and I want to send the message to you clearly, that's all. Okay, any questions? Right. Do you want to have a 5 minutes break before we start the class? Right? Yeah, have a break, because let's break it for 5 minutes and then we'll get on with topic 2. Thank you. Introduction to electrical analysis, leading coincident lag indicators. How are you? Yeah, financial. The issue is, um, the, um, I know you use the statistical function to because the time is The problem is when you do this type of work, you can see everything goes wrong. But when you do it in your calculator, we don't know what's going on. So we encourage you to do this so that you show your work in case if anything goes wrong. Understand that we can see where things go wrong. But you do what studies you do. That's good. You can come during my consultation hour. I will tell you go through that. Okay? So that's good you're doing CFA. Yeah. That's great. That's great. Um, I can't because different people. Yes. Right? I'll go through that with you during my consultation. So, right? Take it. And your name? Your name? Ajwa. Right. Very nice meeting you, Ajwa. Yeah, so that's just at the end, as part of it. Yes. Okay, let's start today's topic. Today's topic is stock selection. Stock selection. We cover chapters 5, 8 and 9. Chapter 5 is about technical analysis side, and also I indicated some of the reading pages on the topic guide. I would like to incorporate more readings on leading and lagging indicators, so that area you need to cover. So please make sure that you read from on chapter 9. I haven't covered that in the chapter reading. You can start from 295 to 308. That is missing, so make sure that you read from in chapter 9, 295 to 308 is also relevant. Okay, that is about what those indicators that give us some leading insights into how the economy is going to go, and what those indicators travel with the business cycle, and what those indicators lag behind the business cycle. As you know, business cycle is also the economic cycle. It tells us about how the economy is moving. Companies, industries operate within the economy, so there is an influence at the level of the macro economy, and then there is an influence, that influence filters down to the industry level, industry in the sense a group. For example, finance, banking sector is an industry. Manufacturing sector, mining sector. Within the industry, you will have subsectors as well. The performance of a given sector, a given industry, or even the subsectors is dependent on how the economy is going to perform, how the global industry is going to perform over that period. So a true analysis in terms of stock selection, you need to understand the global economy, you need to understand the local economy, and then you need to dig deeper into the industry level analysis, and then get down to the company level analysis. So this topic on stock selection is going to look at that aspect, investment process and approaches to the valuation. There are two approaches. One is the top-down approach, or we call it as three-step approach, and the other one is the bottom-up approach. The top-down approach starts from the economy, the large economies around the world. You can, as a portfolio manager, you can study the Asia Pacific region, the Latin American region, the North American region, the European region, and then drill a bit deeper and see which economies you want to invest in. Overweight your investment or underweight your investment depending on economic performance. because each economy is going to perform in different ways, because they have their own macroeconomic variables interfering, right? They have different interest rates, different inflation rates, different intervention in terms of monetary policy levers, different intervention in terms of fiscal levers. So these things are idiosyncratic in the sense they are unique to the to individual economies. So you can decide, okay, I'm going to skip these regions. Maybe Latin American region is attractive at a given point, and it may not be attractive. European region, you can see Brexit is interfering with all sorts of industry performance. So, so it's studying the larger global, regional macroeconomics and markets. Markets, there are different markets. Equity markets, Australian equity market, Chinese equity market, Chinese bond market, Australian bond market. All these operate differently. So you need to decide which, then the money markets. So that is the area that we are going to look at today. So the top-down approach is the formal approach that we will look at. It has macro analysis at the economy level and the market level. Then at the industry level, then we come down to individual companies. So we will answer three questions. Why do we need to do the economic analysis? Why do we need to do the industry analysis? After all, why do we need to do the company analysis? Because not all the companies within a given industry perform at the same rate, so that is a clear indication as to why we need to do company analysis. And not all the industries do not perform uniquely, consistently all the time. Sometimes they perform above expectations and maintain good performance. Some industries perform badly. So we choose the best industries and overweight our portfolio in those industries and underweight our portfolio in those badly performing industries. So we will see the rationale for carrying out the macroeconomic market analysis, industry analysis, and company analysis. As you know, in the last class we learned about the investment process. That process requires commitment of funds for a given period of time to achieve a rate of return. So that commitment of fund for a given period of time comes in the form of time value of money, that is pure interest rates. And also we saw that we live in a world of inflation. The inflation premium is there. We account for that inflation premium. Then also uncertainty is present in all different types of investments. So we need to account for that as well. So these three components contribute to the return that we expect from an investment. If we want to invest in a particular company or a particular industry or particular stock, then we expect certain level of return based on these factors: the time commitment of funds, the inflation, expected inflation in the economy, and also the uncertainty associated with individual companies or stocks. So having generated the rate of return that you require with respect to an investment, you need to identify whether this stock is worth buying. So in order to do that, what you need to do is, let's say we have worked out the return for BHP as 12% return, because that is the return that you expect. Pure interest rate is such and such. The inflation, expected inflation is going to be 3% or whatever, and the underlying risk associated with this mining company or this conglomerate is requires some 7% return. So that feeds into the total expected, the required rate of return. Having generated the required rate of return or equity, return on equity, required rate of return on this investment, what you do is then identify some kind of cash flow, some kind of financial fundamental to conduct valuation, right? So identifying the required rate of return is one side, but making a value judgment on that company using a fundamental is the other side. The usual fundamentals are dividend is one fundamental that is used generously to value assets. How effective that valuation process is again dependent on how predictable that dividend stream is and how predictable that retained profit element that is translated into growth rate, and all these things are things matter. The other financial fundamental is cash flow. So you can use free cash flow to equity or free cash flow to firm. So these are cash flows that you discount and come up with the value. So that is the second part of this lecture, the valuation element. Then also there are other relative valuation measures such as price earning ratio. Price earning ratio is basically you take the share price and divide that share price by the earnings per share and generate this price earning multiple. That price earning multiple tells you about, let's say the price of BHP is 36 and you have the earnings per share of $2. So 36 divided by 2 gives you 18 as the price earning multiples. Price earning multiple tells you so many things. What it effectively tells you is that how long it is going to take to recuperate that investment. It is going to, based on this earnings of $2 per year, it is going to take 18 years to recover your investment. That is what it says. Then what you can do is you can compare that price earning multiples with the market, with the industry, and see if the industry has a lower price earning multiple. Then in that case, BHP obviously is not attractive because it has higher price earning multiples. Again, you can compare it with the market. Market may have a lower price earning multiple. Then you need to decide why you need to invest in this company. So those types of judgments, those are relative valuation models. So we will, you can look at different valuation models to make a decision, investment decision. So estimation of the intrinsic value of the investment at the required rate of return is something that tells you about the value of the company. Using the fundamental, let's say dividend, and then you discount those dividends at the required rate of return which you generated using those three components, then you come up with a value. What does that value tell you? That value tells you intrinsically this is the value of this company. But the price you observe on the market is different. The price is based on individual judgment. The value is based on fundamental variables, and you come up with the value and then you compare it with the market price. Market price is changing all the time. Individuals think differently. You may think BHP is worth $38. I may think it's only worth $37. So I may go and sell my BHP, and you may go and buy your BHP. So these things produce those different pricing process. But in order to make a decision, you need to make sure that you generate the intrinsic value and discount these by discounting these cash flows in the form of dividend, free cash flow, and all those things, and then compare it with the price available. There are two ways to do that. One is to go with the top-down approach, which is starting at the macroeconomy, industry, the markets, and then you go down to industries and then to company level analysis. And the other one is the bottom-up approach. You don't want to go to the economic analysis, the industry analysis. You just want to go and target these companies. Let's take Commonwealth Bank and see if this is worth a good buy. So you just go and attack Commonwealth Bank in terms of valuation and generate the value and see, compare it with the market price. If that is, if the value is greater than the market price, then you go and buy. You recommend buy. If the value is lower than the market price, then it's overpriced. Then accordingly you make the decisions. So there are two approaches, but we will not focus on the bottom-up approach because it's stock selection. You just pick some random stocks without giving due consideration to industries, without giving due consideration to the economic performance. So that is not a very systematic approach. It's just stock picking in a random way. So we will only focus on the top-down approach. So the top-down approach advocates the effects of the economy and industry on the total return of individual stocks. So the top-down approach is very clear. The return that you generate on an individual asset is subject to the performance at the industry level and at the economy level. Not only that, we also go beyond that, and that industry performance is not merely linked to the country level performance. It is also the global performance. Take for example the car industry. The car industry is not just confined to a given country. It is a global performance. There are many countries that are closing their car manufacturing plants. It's a global trend. The return that they generate is a global performance. So industries that operate within a country also is subject to the global trend that we observe in relation to those industries. So these are not isolated performance. So it has to be systematic. Therefore, you need to do a proper industry analysis, the global trend, then the local industry trend, global economy, the local economy, and all these are linked. If anything happens to China, it is going to impact Australia. So the Australian economic growth. There's no two ways about it. So these industries, economies, and all of these are linked. So in order to make a decision at the stock level, you need to also factor in how these macro level indicators perform, right? Then the global economy. Then finally we go for company analysis. It has quantitative and qualitative. Quantitative analysis, you can use any discounted cash flow approach or relative valuation analysis. The qualitative approach will be to study the industry competition, the opportunities available, the threats that are posed by the environment, so how the company defends. All these are qualitative analysis. So if you look at the investment process, we have three-step approach. As I said before, analysis of alternative economies and securities markets. You analyze different economies and markets within those individual economies. The money market in Germany, money market in Australia, money market in China, money market in the US, all these are analyzed. Similarly, the equity market, similarly the bond market. All of these economies and markets are analyzed in terms of bonds, stocks and cash. Then you get down to the industry analysis. You look at, okay, so these countries are going to perform well. Their macroeconomic performance is going to be pretty decent. So we will invest in A, B and C. We will underweight our investment in C, D and E. So those are the economic level decisions. And then within the economy, then you go for individual industry. Do we go for the manufacturing industry? You cannot just go for manufacturing industry just as a thought bubble, but it has to be a deeper analysis. How is the manufacturing sector going to perform over the next foreseeable future? That is not a local decision. It has to be a global trend. So you need to pay attention to that global side as well. On a global basis, and then you go down to industries. Industries have weaknesses, strengths. So you need to see, okay, we stay out of these countries, stay out of these industries, but we overweight in those industries in these countries. So those are the decisions as a fund manager you will decide. Having decided that, then you go down to the company level. Okay, within those industries, not all the companies are going to perform equally, except for industries such as oil, gas and gold, precious metal industries. There the companies within those industries perform almost equally. So you can even ignore at the company level and invest in those indices. Whereas different industries, other industries have different companies performing in different ways. Different companies have different efficiency levels. There are better managed companies and badly managed companies, right? So you need to go for those companies that are going to give you the best outcome. So you need to pick and choose, and those companies that are overpriced must be, you should sell them, and underpriced companies you should target them. So the idea is start from the economy, market, and then go to industry, pay attention to the global trend, and then to the company level. Now go to this Morningstar. Morningstar is a database that gives you industry level information. The library has it. Speak to the librarian and explore that, how they have these industry trends and all those things. Otherwise, I'll have to explicitly incorporate these things into the second assignment, which will be a big pain. Let's think about it. I'm just thinking about how I want to write this case for this second assessment. But you need to have some takeaway, so you need to do something differently. Yeah, so I'll think about it, and I'm planning to give you this second assessment by the first week of August, okay? Bear with me until that point. I need to give you the data, I need to give you all that information so that you go on to do your work. Okay, so that's digressing into that. So macro analysis is based on the belief that securities market reflect what is expected to go on in the economy. So now if you look at the stock market, how it performs, the stock market is a leading indicator. It leads the, bless you, it leads the economy, bless you, it leads the economy by 2 or 3 quarters, right? So it is a leading, stock market is an asset factor of the economy. You will see how the stock market leads the economy. There are different leading indicators, we will look at that. Always the stock market or the stocks you buy reflect what's going to happen into the future, how the companies are going to perform into the future, right? So that's what these expectations about how the economy is going to perform. So expected cash flow, expected cash flows from the investment and expected required rate of return. You need to look at these 2 measures, how the expected cash flow is going to evolve and what expected return are we going to have. Expected return, again, that's dependent on how the expected inflation is going to be, how the expected risk is going to be. All of these things feed into your expected required rate of return, which is the discount rate, and expected cash flows. Expected cash flows can be your free cash flow to equity or free cash flow to firm or even dividend. So you just discount those cash flows and come up with the value. This is evident in the, so if you look at the bond market performance, for example, corporate bonds, they are dependent on the performance of the corporate bond is decided by the overall interest rate that prevails in the economy, the decision by the Federal Reserve or the Reserve Bank of Australia as to what the interest rate is going to be. All these things feed into how the corporate bond market is going to perform, right? So that's how, this is all about expectations as to how the economy, the market is going to perform. Similarly, investor expectations about corporate performance in terms of earnings, cash flows, all of these decide how, all of these are dependent on how the economic outlook is going to be. So there is a clear relationship between the economy and the stock market. Empirically, they have proven, if I can take you to this page, okay. So these are the leading indicators. If you look at this, hang on. $299. Okay, if you go to Exhibit 9.4 on your textbook, now these are the leading indicators. For example, average weekly hours of manufacturing is a leading indicator as to how the economy is going to perform. Now, if you look at the factor, the weight is 0.2774, which is quite a high weight in terms of the contribution this indicator makes. How the economy is going to perform is, how did they arrive at this 0.274? What you do is you take all these different series, let's say these 10 series, and run a principal component analysis. You do some statistical analysis, and then that statistical analysis produces the weight associated with individual indicators. Now, based on this, obviously, this is the least important leading indicator, building permits, which is 0.0298, but the average manufacturing hours is one of the leading indicators. If the manufacturing hours, so looking at the manufacturing hours, we will be able to predict how the economy is going to perform. right? Similarly, the ISM New Orders Index, Purchasing Managers Index, consumer expectation, interest rate spread between 10-year and US Federal Reserve. The interest rate spread tells you the difference between the 10-year yield and the Federal Reserve rate will tell you how the yield curve is going to shape up. If the yield curve is going to be upward sloping, then that gives you an indication as to how the economy is going to perform. If the yield curve is going to be flat, that is telling a story about how the economy is going to perform. If the yield curve is inverted, that is also telling a story about how the economy is going to perform. Upward sloping yield curve tells you the economy is going to grow. Flat yield curve indicates there is a chance that we may have a yield inversion, which will end up with negative or decline in performance, or even potential recession. So these, if you want to make sense of how the economy is going to go, how the industries within the economies are going to perform, so as well as the companies within those industries, then you need to pay attention to these leading indicators, how they are going to. So this is how you make sense of how the performance is going to be. So the Reserve Bank and all these economic decision makings are made by looking at these leading indicators. Okay, so empirically it has been proven that stock market leads the economy by 3/4 or so. Okay, the possible reason for the leading role of this stock market indicator is that stock prices reflect forward-looking information. Because if the economy is going to do well, then it will be reflected by the stock market. 3 quarters ahead, it will show you how the economy is going to perform. If earnings are going to be better, growth rate is going to be better, then it will be reflected in the stock market. And if all these things are negatives, then it will be reflected early enough to show how the how it's going to affect the performance. If you look at this, let me just take you back to this. Okay, now this exhibit 9.5 tells you these are the recessions. These gray lines are the recessions. You can see all these 10 variables we identified with different weights have been put together, and an index has been created, and now we can see how the whole thing is telling us a story about how the economy is going to move. Here you can see before the recession hit in the 70s, now the indicator turned down at this point. Indicator turned down. You can see it's by 1 year ahead or 1.5 years ahead of performance, maybe 2 years. And similarly then before the economy gets out of recession, the indicator turned upwards, right? Here you can see the indicator turned downwards before the economy hits the 1975 recession. And again, you can see the recovery takes place early enough in this leading indicator before the economy moves out of recession. The indicator indicates that we are heading towards growth again. And similarly here, everywhere you can see clearly what it tells you is these leading indicators lead the economy by certain number of quarters, right? So what does it mean? What it means is that these indicators have tangible information. By looking at these indicators, you will be able to see how the economy is going to perform, right? So go through this section, please, on page 300 and page 300 and 301 on leading indicators. Okay, so stock prices adjust in response to expectations formed with respect to leading indicators, money supply, interest rates. Think about this. Now, the Reserve Bank has reduced the interest rates again. Why? Because naturally the central bank, whether it's Reserve Bank of Australia or Federal Reserve or whichever, they go into an expansionary policy or contractionary policy. If they think that the economy is going to move into difficult territories, then they will go into a very expansionary monetary policy where by stimulating growth rate and reducing interest rate and stimulate growth rate, right? Whereas if the economy moves into a phase of overheating, then naturally the inflation is going to kick in and it's going to be out of control. Then they will apply a contractionary monetary policy by increasing the interest rate. They will slow down the economy and get the heat out of that economy and then move back into the normal phase. They pay attention to all these leading indicators, including manufacturing hours, purchasing. One of the leading indicators is the Purchasing Managers Index, which tells you how the purchasing manager feels confident about purchasing activities in the US. So that index is a clear indication as to how the economy is going to perform. So GDP is a useless indicator because, you know, it is released way before it is released. There are other indicators. GDP is not part of the leading indicators, right? There are other indicators that tell you a story about how the GDP is going to evolve. Okay, right. So that is the economy-wide analysis. There are leading indicators and also there are lagging indicators and coincident indicators as well. Let me just show you that. So have a look at this is the coincident indicators. They just go hand in hand with the business cycle. Employees on non-agricultural payrolls, for some reason non-agricultural payroll has a higher weighting. Personal income, less transfer payments. Again, that series, that index tells you something about what's going on in the business cycle. Industrial production, manufacturing. Then there are lagging indicators. So this is, you can see, coincident indicators. They are with the business cycle. The business cycle is captured by these recessions. They move in tandem with the business cycle. Then there are lagging indicators. Average prime rate. Prime rate is the rate at which bank lends money to financially credentialed firms, right? There are bankers here. Is that right? The prime rate? It's the rate at which banks lend money to creditworthy firms. Then consumer price index, again it's a lagging indicator. Inventories to sales ratio, lagging indicator. So these, but then again the higher loading is associated with the prime rate, CPI, and so on. So have a look at those things. Please read them. These are very important things that you need to make sense of. You can see how these lagging indicators perform. They fall behind the business cycle, that is evident in this performance. Then you have this leading indicators and lagging indicators as a ratio. The coincident indicators to lagging indicator as a ratio, that produces another leading indicator, because that ratio is sensitive to all these leading performance. So that again gives you, here you can see how this ratio of coincident to lagging, these are the coincident indicator and the lagging indicator, but when you generate as a ratio, it becomes a leading indicator, right? So that tells you how sensitive that ratio is to the economic performance. So just read that as well, please. Then you have other leading indicators. Page is 306. Page 306 is about the yield curve. Now, this exhibit 9.13 is the spread between the term spread between the 10-year yield and the 2-year yield. 10-year yield is the yield applicable to a 10-year bond, and 2-year yield is the yield applicable to a 2-year bond. The spread between the 10-year bond, yield on the 10-year bond and 2-year bonds, gives you indication about how the yield curve is going to shape up. Okay, so the spread, we call it as term spread, tells you about how the yield curve is going to shape up over the next few years. Now, what is a yield curve? Yield curve is a curve that captures the yield applicable to different bonds with different terms to maturity. You will start with the 3 months instrument, 6 months, then 1 year, 2 years, 5 years, 10 years, and 30 years, for example. That yield curve is normally upward sloping, because you normally expect lower yield associated with short-term instruments and a higher yield associated with long-term instruments, because by nature these long-term instruments are susceptible to interest rate risk and all those types of risk, reinvestment risk and so on. So what the yield curve tells you so many things about how the economy is going to perform. How do you understand the shape of the yield curve, whether it's going to be upward sloping or it's going to be flat or downward sloping? You take the spread between the 10-year yield and the 2-year yield and then generate a graph. This graph is the spread between the 10-year treasury bond and the 2-year treasury bond. So that tells you how the yield curve is shaping up. From 1980 to 2015, you can see here we have anything above zero is an indication that the yield curve is going to be upward sloping. Upward sloping means we are going to have pleasant economic growth. Now, the indication of staying around zero spread means the yield curve is flattening. When the yield curve flattens, it is likely that it will invert and it will be downward sloping. So you can see as it reaches zero, then it goes into an inversion mode. Anything below zero is inverted yield curve. Inverted yield curve means getting into recession. Inverted yield curve means getting into recession. Why? Because you have a situation where the yield curve is, let me just use the camera. Okay. So this is the terms to maturity. This is the yield. So normally you expect the yield curve to shape up upward sloping. Sometimes you may have a flattening yield curve as well. Sometimes the yield curve may be downward sloping. So anything anything along the line of zero indicates a flattening yield curve, which is not a good sign. The flattening yield curve again then leads to negative or the inversion of the yield curve. And anything above zero is upward sloping, anything below zero is yield inversion. Yield inversion means almost you can see with all the inversions lead to recession. You know, these gray lines are the points where we experienced recession. So you can see how these yield inversion lead to is acting as a leading indicator about how the economy is going to shape up. So that's clear. So yield curve has a lot of leading information as well. Okay. Any question on that? So read those things, please. Then having looked at these economy level indicators, now we move to the industry analysis. Industry analysis is about analyzing different industries. You can use the business cycle and the industry sectors, how the individual industries are related to the business cycle. I'll go to this. If you look at here, this is the business cycle, economic cycle or business cycle. It goes through a peak and trough period. And you can see this is the behavior of a fund manager who uses the sector rotation strategy. Sector rotation strategy is a strategy where you ride the yield curve, you ride the business cycle. You ride the business cycle by positioning your portfolio at a given point of the business cycle to take advantage of the performance. Look at this. At the at the near the this is the peak of the business cycle. Then you experience this recession. Before the trough reaches, a sector, a specialist rotating sectors will invest in the financial stocks. Financial stocks, you don't want to invest at the bottom end. You want to invest here because you will capture those prices at a very low end to take advantage of the next move. So nearly at the end of the recession, before it reaches the trough, you will invest in financial stocks, because as the economy turns up, the financial sector will start performing well, because people will start investing, people will start building houses, and the financial sector will perform. So before the economy reaches the trough, you shift your fund towards that sector, and that sector, and then take advantage of the ensuing performance. Then consumer durables, at the trough, you buy those consumer durable stocks, and then experience that growth as the economy recovers. Then capital goods, as the economy steams ahead, people will start buying fridges and all these, not the consumer durables, the manufacturers will start buying machineries and equipments, and the capital goods sector will pick up. And then as the industry peaks, as the business cycle peaks, then invest in basic materials. This is the behavior of a fund manager who is engaged in sector rotation by riding the business cycle, and timing and investing in those stocks. Okay, industry analysis. So that is the business cycle and industry sectors. Then structural and economic changes. Okay, and as part of the industry analysis, one also needs to understand the structural changes in the economy. Structural changes in terms of technology, in terms of demographic changes. There may be changes in the structure of the populations. Those things have to be considered, and those are related to the structural and economic changes relating to the structure of the economy. Then the third analysis relating to industry analysis is the industry life cycle analysis. An industry goes through different phases, infant stage to maturity stage, and at those different phases they go through different growth rates and different patterns of, that's on page 321. If I can go to, sorry, 321. Okay, so you can see how an industry goes through these different phases of growth. Pioneering development stage, then rapidly accelerating growth, then the maturity stage 3, stabilization and market maturity, and then the deceleration. Now, under these different stages, during the pioneering stage, you will tend to have negative profits. For example, if you look at these companies like Tesla or Uber, these companies, I don't think they have earned any profits. their profits is negative profits and modest sales, and then they move into rapid accelerating growth. During that phase, the market develops and becomes substantial. Sales grow at an increasing rate. Excuse me. Sales grow at an increasing rate. And then during the mature growth period, that is the third stage, profit margins, high margins attract competitors, sales growth no longer accelerating, growth rate may be a bit higher than GDP, but profit margin tend to decline. Then during the middle age, growth declines to GDP growth rate that grows in par with the economy. Again, profit margin vary by industry, and returns on capital down to cost of capital. At the final stage, declining stage, sales growth declines due to shifts in demands and substitutes, and low profits and losses. So the industry is in the declining phase. So you need to, when you conduct the industry analysis, you also need to pay attention to the stage at which the industry is at. So this is something that is related to the industry life cycle. Then you also need to analyze the competitive environment and who are the competitors and what sort of competition you have, so that you can do using that's on page where is that, SWOT analysis and competitions. That's on page 330. Please have a look at that as well. So you can go through this and understand. So why do we need to do industry analysis? Industry analysis obviously help identify superior investment, and studies on industry analysis have proven that there is no consistent performance. You cannot look at the past industry performance and predict how the industry is going to perform into the future. There is varying performance, so you need to do industry analysis as part of your investment decision process, because past performance has no relevance, has little value in projecting future performance, and also the industry risk also diverse. The industry risk, the dispersion of industry risk also differs from industry to industry, but there is some consistency within industries in terms of risk measure over time. You can see by looking at this exhibit 9.21, you can see how different industries and subsectors perform differently. 1 year return, you can see audio and video equipment sales earned a 3,000% return. Whereas if you look at the subsector Dow Jones platinum and precious metal during that period, earned a negative return of 49%. You can see by carefully studying industries how one can make investment choices that can produce better performance. So the need for industry analysis is clearly evident, that different industries, different subsectors perform differently at different periods of time. So proper gauging of how the industry is going to perform is critical to your investment outcome. Yeah. Then the third analysis is, company analysis. Why do we need to do company analysis? Well, different companies within a given industry perform differently. So not all the companies perform in the same way. So we need to dedicate time to do company analysis and select the best companies, that perform well. But there are companies within certain industries such as oil, gold, steel, autos and railroads. They perform similarly. So you may not need to study them at the company level, but industry analysis would be sufficient. Company analysis and stock valuation after completing the economy and the stock market for various countries. You will have a clear information about weighting portfolios with respect to countries and industries. The final question then boils down to which are the best companies within the subset of industries and countries and industries. So you, having decided the countries, having decided the weight with respect to individual countries and the industries, then you come down to which companies to go for. Okay, so there you go for the intrinsic value of the firm. Intrinsic value is internal to the firm that produces the value, and then you compare it with the price. So how do you work out the intrinsic value? Let's look at that in the valuation process. Then you compare it with the prevailing price, and if the value is greater than the prevailing price, then you buy. If the value is less than the prevailing price, then you sell. Right? Business cycle and industry sectors, I have covered this structural change and also the how the stock market goes with these different areas of the business cycle. So these are some of the important leading indicators, interest rates and so on. So have a look at that. Okay. Industry life cycle, again, we looked at the 5 stages: pioneering, rapidly developing, maturity and deceleration stages. Exhibit, this is 9.23, sorry, that should be 9.23. We had a look. Now we move down to company analysis and the valuation. The value of an asset is the present value of the expected cash flows associated with that company. Discounting those cash flow streams produces the value. So you need to have those cash flows and the required rate of return that is expected, and then identify those cash flows and discount them to arrive at the intrinsic value of the company. The required rate of return again has 3 components: the economy's real risk-free rate, the expected inflation associated with that inflation during the holding period, and also the risk premium associated with that. So those 3 components we already covered. Okay. So the required rate of return, expected inflation, and the risk premium. Items 1 and 2, naturally the risk-free rate is common, the inflation is common to all the firms. It is the risk premium associated with the uncertainty of the firm is going to be the difference, and going to make the difference in terms of required rate of return, because the risk-free rate and the expected inflation is expected to be the same. There are 2 approaches. One is the discounted cash flow approach, that you take all the cash flows, whether it's a dividend stream or free cash flow or free cash flow to equity or firm, and discount those cash flows to arrive at the value. The second valuation approach is the relative valuation approach, but the relative valuation approach can be earnings multiples, price earning ratio. It's relative to the price. These are the two approaches. One is the relative valuation measures are price earning ratio, price to cash flow ratio, price to book value, price to sales ratio. These will indicate about the relative value of the company, and these are discounted cash flows. You can discount the dividend stream or operating free cash flows or free cash flow to equity and arrive at the value. The focus of this unit will mainly target dividend as the cash flow measure, and obviously for this discounted cash flow technique, the cash flow is going to be dividend. We just take all the cash flows from T1 to N and discount those cash flows and sum it up to arrive at the value. Value is the value of the stock. Let's look at this. Under the dividend discount model, what we do is we make a prediction of dividend from next year to infinity and discount those dividends with the required rate of return. 1 plus the required rate of return produces the value of that company. But the issue is how do you forecast dividend from next year to infinity? That is not feasible. So what we do is we using the I'll come back to that. Using a small manipulation, we come up with this invoking this perpetuity principle. The dividend discount model is basically dividend in year 1 divided by K minus G. That is, K is the required rate of return, G is the growth rate. Okay, let's look at going back to this. So the value of the company, if you can predict the dividend for the first 2 years, D1 and D2, discount them, and then you predict the share price at the end of the third year, end of the second year, by calculating all the dividends from D3 to infinity and discounting at using year 2 discount factor to arrive at the price. So these are the individual dividends discounted, and the share price at the end of the second year produces this value. So this dividend discount model is a well-known model, you all know. If you want to go, please use the back door. If you want to leave. So D1 divided by K minus G produces that value. The model assumes that the K, which is the discount, the required rate of return, is greater than the growth rate. If the required rate of return goes below the growth rate, then what happens is you are talking about the company growing beyond the economic growth rate. That is not that assumption will not hold. So we always assume that the growth rate will be less than the required rate of return. If the growth rate exceeds the required rate of return, this model will explode. Okay, let's look at this example. Imagine that you are trying to value Bringer International Incorporation, and you conclude that it will have $3.05 as cash flow next year. You don't need to forecast the cash flows until infinity. You only need to forecast the cash flows for next year and then invoke the perpetuity principle, K minus G. So in this case, 3.05, you conclude that it will have 3.05 of cash flow next year and will be available for the shareholders. The cost of equity is 10%. The expected growth rate in the future is going to be 3.3%. So the expected cash flow, the expected dividend is 3.05. That is the D1 element, and the required rate of return is 10%, and the growth rate expected is 3.3. So 3.05 divided by 10% minus 3.3% produces $45.60. That is the value of this stock. So you don't have to go through each and every dividend component from D1 to infinity. You only predict the dividend for year 1 by taking dividend in year 0 and working out a growth rate and multiply that and arrive at the dividend in D1 and then divide it by K minus G. That gives you $45.60. So it's a dividend in year 1, then the required rate of return minus the growth rate produces that value. At the current time, EAT is trading at 43. By using this approach, most analysts would feel that it's almost fairly valued. It's 45, 60. Naturally, it's a sell, but it's a fairly valued element. Then we can also have multiple growth rates where you have a normal growth rate, then you also have supernormal growth rate, and then it boils down to a normal growth rate. In that case, what you need to do is you need to capture all the dividends individually during this supernormal growth rate and discount them individually, and then invoke that perpetuity principle for the terminal growth rate. Let me tell you this. Let's say a company is going to grow at 15% growth rate for the next 5 years. Then from year 5 onwards, the growth rate is going to settle down to 5%. So this 15% is a supernormal growth rate, and then after that it settles down to the average normal growth rate. So we can invoke that perpetuity principles, K minus G. So in such a situation, what we need to do is we need to value those individual dividends, arrive at those individual dividends, discount them and add them up, and then work out the terminal value with a constant growth rate. So this is the abnormal stage 1 growth, and then you have the stage 2 constant growth. Now let's look at this example carefully. We examined Cisco Systems in 2000, at the height of the technology bubble. Assume that Cisco had a 53% dividend in 2000, even though 53% was actually Cisco's earnings, so we entirely pay that. Imagine that you thought that Cisco would grow their dividend per share at 20% per year for 5 years, then the growth rate would subside to 5%. So Cisco is going to grow at 20% for 5 years, then it just settles down to a constant growth rate of 5% forever. So how do you value this company? Well, you need to work out the dividend for next year, that is 2001. So 53 cents. 53 cents. So 0.53 times 1.2 produces 63.6, that is 64 cents for 2001. That times against in 2002 it is going to grow at 20%, so that times 1.2. The dividend for 2002 is 76 cents times 1.2 is the dividend for year 3. It's 91.5, 92 cents. And then for year 2004 again 1.2, that gives you $1.10. $1.10. In 2005 it's $1.32. So $1.32 in 2005. For 5 years it is going to grow at 20%. From year 6 onwards, it is going to, from year 5 onwards, it is going to settle down to 5% growth rate. Yeah? So that means 132 times 1.05. 1.05 gives you $1.38, right? $1.38. All you need to do is work out these values for individual years during this supernormal growth and arrive at those dividends. 2001 64.76 cents and $1.10 and $1.32, but you cannot add them up. You need to bring them to a common ground by discounting them, right? What is the discount rate? Cost of equity is 12%, right? So 0.57 divided by 0.664, right? 0.64 divided by 1 plus the required rate of return is 12%, 1.12 gives you 57 cents, right? Does it make sense? So that 64 cents that you are going to receive at the end of 2001 is equal to 57 cents at the beginning of 2001 or at the end of 2000, right? Right? So that 76 cents that you are going to receive in 2 years' time, so 0.76, right? 76 divided by, let me just, 1.1, sorry. 0.76, let me just, 0.76, 1.12, right? So let me just 1.12 to the power of 2, right? Because it's the second year. So that gives you 60.58 or 61 cents. Similarly, you need to do for year 3. Year 3, it would be whatever, that 92 cents. 92 divided by 1.12 to the power of 3, that gives you 65 cents. So if you want to interpret this, that 92 cents that you are going to receive in 3 years' time is worth only 65 cents in today's term, right? That $1.10 that you are going to receive in 4 years' time is only worth 70 cents in today's term. So we are trying to bring them all to the common ground. That is today's term, 57, 61 cents, 65 and 70. And this $1.32 that you are going to receive in 5 years' time is only worth 75 cents in today's term. So you can add them up, add all of these things. And then in 2006, it settles down to an average or constant growth rate of 5%, right? 5%. So that dividend is 1.38. At this point, we are able to work out the terminal value as 19.78. I'll just go through that terminal value. Okay. So how did we work out this terminal value? The terminal value is the year 6 dividend. 2006 dividend, right? 2006 dividend is how much? It is $1.38. How did we arrive at this $1.38? We had 2005 dividend of 1.32 times. We are going to settle down to a constant growth rate of 1.05. That is equal to 1.38. Now, having arrived at this 1.38, so that is 1.38, that is the dividend for 2006. We apply 2006 dividend divided by K minus G. So 2006 dividend, we know it is 1.38 divided by K is what? That is 12%, right? 0.12 minus, what is the 5%, right? 0.05. Let's do that. 1.38 1.38 divided by 12 minus 5 is 7%, right? 0.07, 19.71. Now, 19.71 should be just because we rounded this. It will be 19.78, right? So, because we rounded all these dividends, 1.32, 1.38, but you shouldn't round it up. You should maintain the normal digits, and the actual value is 19.78. It's just what I got was 19.71 because I was using the rounded values. So what is this 19.78? This 19.78 is the terminal value. From 2006 onwards, from the end of 2005, the company is settling down to a growth rate of, constant growth rate of 5%, at which point we are able to invoke that perpetuity principle of K minus G. Otherwise, we'll have to identify each dividend from 2006 to infinity, which we cannot do, right? So we just take the 2006 dividend. It is like D1. It is like D1 over K minus G. So we are able to do that only when we see that constant growth kicking in. We had supernormal growths from 2000 to 2005 of 20%, and then from 2006 onwards it's settling down to 5%, right? So that gives you this 1.38, which is the terminal value, but I'll do a comprehensive question later that you will understand this. So 19.78, that is the terminal value, but if you discount that 19.78, but what is the discount factor? The discount factor should be 2005. Why? Not 2006. Because we saw that constant growth rate at the end of 2005. We are making this terminal value calculation at the end of 2005. Therefore, we should use only the 2006 5 discount rate. So what is the 2005 discount rate? I'll do a comprehensive question, so don't worry, you will understand that. 2005 discount rate is 1.12 to the power of 5, right? 11.22. That is what you get, right? So all you need to do is you need to work out the individual dividend for each year during the supernormal growth and discount them using the cost of equity, that is 12%, 1 plus that discount rate, gives you the present value of all these dividends up to this point. Then this is the terminal value. That what is this 11.22? So that terminal value that we see at the end of 2005, which is 19.78, is only $11.22 in today's terms. In today's term, it is only worth $11.22. Now we are able to add them up all, right? You may have confusion about why should we use 2005 discount factor instead of 2006 discount factor. The reason is, even though we use the 2006 dividend, we are doing this at the end of 2005. So we are discounting that using the 2005 discount factor. I'll do a comprehensive question when we go through the questions next in the next class. Then the final section is the technical analysis. So make sure that you cover all these industry analysis, market-wide analysis. Please read that. Read the sections on those chapters. You will understand it's a nice reading and it's a nice set of things that you will learn as to how important they are. Finally, the technical analysis is not like fundamental analysis. It's based on looking at the past prices and volumes to make buy-sell decisions. Um, and disregards any information coming from the financial statements, and you make the buy-sell decisions based on how they shape up. Now, up to this point, it is rising trend. Then this reaches the peak. At this point, you sell. Then declining, and the trough, this is the buy point. So it's using the past prices and volumes. Technical analysts come up with buy-sell decision at different stages of the pricing cycle. So that is the technical analysis. That's from chapter 5. Have a look. So we have looked at the economy-wide analysis, the industry-wide analysis, company analysis. Company analysis focus on valuation. We will use the dividend discount model, and I'll do the question next week, and then also have a look at the technical analysis. So develop some. So these are things you can read on your own and understand. The important thing is answer these 3 questions. Why do we need to do macroeconomic analysis? Why do we need to do industry analysis? And why do we need to do company analysis? Any questions? Thank you, and see you next week, and we'll start on asset pricing.
Formulas.
No, you don't have to.
Oh,
So that's why I didn't focus much on this. Understanding is important. When you do that question, I'll go through this part.
right.
Yeah, don't worry. Thank you. Thanks.
I just had a small question regarding
Yeah,
this.
sure.
Just wanted to know if it's compulsory for us to make any limit orders, or if it's okay for us to have all the orders on market price.
Do as you like.
But it's just the 5 small cap and 5 large cap is the only specification.
Roughly maintain that.
Yeah, but otherwise there are no specifications.
Yes. Do as you like. It's a learning process. Yeah.
How do you define a small cap and small company class? Is it like just stock companies of 10, or is it all assets 200 include all of those?
Go to the Australian stock market. The list of small stocks. List of large stocks. These are based on size. You see the list of small stocks, list of large stocks. Based on the
Thank you.
All right. Thank you. Thank you. Thanks.
Stock track, yeah. But can I attend this lecture even if I'm not allocated?
Of course, you should attend.
Yeah, because actually it's clashes with my other
okay,
unit, so I thought I can do like alternative weeks.
Yeah.
So probably one week other lecture and then other day.
Yeah, you can come.
I was very good
What's your
lecture.
name?
Bhavika.
Bhavika.
Yeah, I can email you.
Yeah. That's right.
So
So, how is the stock track going?
it's not working, which is why I came here to see you.
Alright.
So
Okay.
I'm not sure. I think I have
Yeah.
registered successfully, maybe.
Yeah. So, did you?
So it's still not working.
Why is
And
that?
I don't know. Whenever I log in and go here to to do
This
this
market
trading.
is now closed. Okay, that's understandable because the market is closed, right? Okay, trading. And go to here. Okay, so go here. Let's say BHP. Yeah, equities. Enter the unit that you want to buy. Let's say 3,000. Right? We want to place the market order. Right? Because the market is closed. Last price it is 40. If you want to place a limit order, let's say you can say 42, right? 42, good till cancel, so that means until you cancel, so you will,
Oh, that is the rate, yeah?
yeah,
48 or 42.
42
Yeah,
is
yeah.
the price that
Yeah.
which you want to buy, right? So the estimated cost is this much, and then you need to make PHP, some notes, PHP, limit order, huh? That is find and confirm success. You have both them.
Oh.
Yep.
Oh,
So
okay.
you,
So,
you keep going, keep doing
I
it.
can still do it.
Yeah.
Which is why I literally wasted like 4 days. I
Oh,
should
really?
have
Where-
Yeah, I even emailed them saying.
It can be misleading.
Okay, cool. Is it somewhat like easy trade because in last trimester I did trading in currencies?
Yeah.
Is it somewhat the same?
Yeah, you can now. This is stocks. You
Yeah.
can do the trading.
Oh, cool.
Yeah.
Thanks a lot. So I can attend the lecture, yeah?
Yeah. So what
Perfect.
course are you doing?
I'm doing MBA International, majors in finance.
Good.
Yeah. Thanks a lot.
So you're doing a major in
Yeah.
finance. Okay, good.
Yeah.
Okay, so do the trading.
I'll sign it down.
So, yeah.
Can I still do it on weekends?
The weekends the market is closed.
So at least 2
So
more
essentially what you need to do is, no, you have